Welcome, welcome. Everybody come on in. Let's get that chat working as you guys are coming in here. Just drop in the chat where you're coming in from. Make sure that we get the chat working and we'll get all set up here. So, I'm super excited for tonight. It's going to be awesome. Looks like we have Annie from Beaumont. We've got David in Woodlands. We've got New Zealand. Yes, Greg, love it. Tokyo, David, wouldn't miss you. Okay, awesome. Let's keep that chat going. You should be able to chat with other people in here as well. So go ahead and drop stuff in the chat. And I believe you should be able to chat with other folks in here. Yeah, you can chat with everyone. So awesome. Well, let's go ahead and get started here. And as more people are coming in, we will welcome up our guests or our panelists. We have an all-star panel today. I'm super, super excited about it. I mean, if I could just have like my dream panel, this is it tonight. So I always feel like you ask for the best people you can, and they can always say no. So fortunately, they all said yes, which is awesome. So we've got my good friend Ken Mcelroy is here with MC Companies. We've got Mikey Taylor, Commune Capital, Ellie Perlman with Blue Lake Capital, and Justin Donald, the lifestyle investor. This is thriving in unpredictable real estate markets. So we're going to talk about what's happening in real estate market today with rates dropping a little bit, with uncertainty out there. Is it a good time to invest? You talk to certain people, it's always a good time to invest. But what are the risks and the opportunities going on today? We're going to do some Q&A at the end. It's going to be awesome. So who's excited to be here today? Is anybody in the chat excited? Maybe you can put who you're excited to hear from. And honestly, one thing that I love is getting really smart people in the room and being able to let them talk and interact with each other. So let's hear in the chat who you're excited to hear from. I'm going to welcome them up here, and then we're going to get started here in just a minute. And so let's get going here. This is going to be awesome. Ooh, I'm fired up. All right. Here we go. Okay. Okay. And I got to welcome up. Let's see. Let's get everybody up here. Okay, I think we've got everybody on stage. Awesome. All right, guys, welcome. Just gave you a quick intro. Really excited. We're going to go around and hear from each of you guys, and then we'll kind of do some group questions here. But let's talk a little bit about where we're at right now. I know we've been through some stuff, particularly in multifamily, where it has been a little challenging. It's gone from being a great everything, anything you buy, especially for about 10 years, from 2010 to 2021, 22. It was if you just owned, you were a genius. And we've seen some things kind of change a bit. We've seen the tide come out. We've seen who's been swimming naked, particularly with debt and other things. But Ken, I wanted to ask you. You've been doing this a long time. You've navigated multiple real estate cycles. What specific strategies do you recommend for investors during down markets or just in times like now where there's some uncertainty of kind of where we're headed? It looks like you muted there. There you go.
No, can you hear me?
Yeah, I got you. You're good.
So it's actually quite simple. Like when a lot of people are buying, you probably should raise your eyebrows and go, And then when they're not, that's when it's hard, and that's when you should be. So right now, there's a lot of people that are on the sidelines. They're trying to work out their debt, and they got cash flow problems, and they're raising capital and everything, trying to stay relevant or liquid or whatever. So it's a really, really good time to talk to lenders and talk to GPs, talk to LPs, look at deals. So it's complicated, but it should be like, it should not be what we just experienced, which is, fog a mirror and raise some money.
Yeah. Absolutely. Yeah, definitely things have changed. Ellie, you've been in syndication for a long time. We've been friends for a long time. And I know things have changed. Things have changed the last couple of years. We've seen a significant change in, both, how deals are done, how profitable they are. There's, raising money, investor sentiment. Actually, I ran into Michael Blanc. Some of you guys know Michael Blanc at the airport. And he said raising capital for him was down about 90% of where it was, 3 or 4 years ago, which is interesting. But talk to us a little bit about just kind of some of that sentiment in multifamily and kind of what's changed, what's different now.
Yeah, absolutely. I think it's very interesting to see how many investors, essentially became more sophisticated alongside with sponsors, because in the past 10 years, what many have known was essentially a deal or deals, portfolios that it was easier to manage. Raising rents, $300, $500 a month, $600 was not very, very hard to do. And now, and that was, like Ken mentioned, that was abnormal. And now it seems like it goes back to normality. And so I feel that investors' expectation and sentiment has shifted, where 2 years ago, a year ago, a lot of investors were out of the market, whether there were other capital calls on the portfolios deals that they have invested in, or they just wanted to pause for a moment, digesting, see where the market is moving into before making another decision. And essentially now we do see capital coming back from both high net worth and from family offices and institutions. So we used to hear a lot a year ago, even 6 months ago, we're sitting on the sidelines, we're not deploying any capital. Now we're hearing exactly the opposite. We hear a lot of groups that say we are allocating money for Q1, Q2 next year. It's good that we're talking now because we're kind of gearing up. Some of them say that they have capital to deploy right now. And so we do see some positive movement. It's not as fast and easy as it was years ago. And easy is, nothing is easy in real estate ever. It's all relative to where we were a few years ago, where it was, easier to raise 20, 30 million, $40 million for a deal. Now it's slower, and maybe it should be, because, investors know many times that, they know how to ask the hard questions, and that's good. I always say that if you're not comfortable with your decision, just do not invest. There are always deals out there. So if it's not this one, it will be the next one.
Yeah, we've taken about a 2-year break in multifamily just because the deals, it was harder to pencil them. And now just the last few months, we've been very busy because we know that as rates drop, and I think it's nice to be a little bit ahead. So I think that's great, kind of what we're seeing now. Mikey Taylor, it's great to have you here today. Welcome. And I feel like you're a superhero, man. You go from professional skateboarder to investor. Now you're, a city council member, which I know you have a meeting right after this, which is awesome. But talk to us about, recession resistant asset classes that you're in, such as storage units, multifamily. What are some things you're seeing in those? And what are some things that you're excited about in the current market?
Okay, before I start, I'm going to echo what Ellie said, but from a retail investor, because this is the primary base of our investors, we saw a similar thing with them as well. 2023, very difficult year to raise capital. 2024, completely different, actually. You're seeing a lot of people that were on the sidelines that are now entering, even on the retail investor side. So I would totally agree with you. So the two asset classes that I build and manage are storage and multifamily, which are, when we go through hard times, they historically perform, I think, better than others, but that doesn't mean that every multifamily or storage deal works. You still have to be pretty disciplined with your underwriting. And something that we do as a firm is we kind of go a step beyond, and we look at all of the factors that can typically go wrong when building, and we try to kind of size that into our deal. If construction takes an additional year, what does that do to our return? If we have to give rent concessions, what happens to the potential return? If cap rates move by a point, what happens? And we try to move forward on deals that when everything goes wrong, we could still make a little bit of money. We're not going to have a double-digit IRR, but we can still make something. That's typically what we do. I would say what we're excited about right now is kind of what Ken mentioned. People are on the sidelines. The competition is out, which means you can get deals, but you have to remember that real estate is fragmented. What works where I'm at does not work everywhere. And our strategy, I think, on the development side is a better place to be right now than some of your stabilized or light value add. We're just getting more of a premium to build than you do on maybe some incremental rent growth. Plus, the financing option for that strategy is just a little bit more challenging right now.
Thanks, Mikey. I appreciate it. That's great thoughts there. Justin, I know you're talking, a lot of your approach really is about hedging against uncertainty. And so you do, multifamily among with VC and other businesses and things. How do you, how do you advise? I know we don't really give advice to investors, but what are some things that you're noticing now in this market, I guess, when it comes to real estate as well as other assets?
It's interesting if you look at everything from like a macro standpoint. If you look at the family offices, which are the groups that basically manage the money of the wealthiest people, especially more specifically single family offices, You are seeing alternative investments growing. You're seeing, the investments in public equity shrinking. So it's fascinating to see. Real estate is growing, private equity is growing, more specifically, but there's always ways to hedge. I mean, part of the way that you hedge is to be really smart about what allocation you put of your net worth in any single deal or in any single asset class. So those are great ways to hedge. You can hedge by, just making sure that the assets you're buying are actually cash flowing today. So that way it's not, you're not basing it all on appreciation. The appreciation is kind of like a byproduct, and you're never stuck in a situation where you are forced to sell if something is actually cash flowing. And then there's other things that you can do beyond just real estate. I mean, for me, like I got my start in mobile home parks. And from there, I all those cash flow really well. And so I had this extra money. And so then I got into industrial and multifamily and self-storage and many other niche asset classes as well. And there are always deals. I mean, that's the bottom line. There are always opportunities, and you may find less of them in certain markets, but that doesn't mean that you can't find them. There are always people looking to sell, and we have more baby boomers looking to sell assets than like in history. I mean, we're embarking on, the next, 5, 10, 15, maybe even up to 20 years. That's going to likely be some of the most robust buying opportunities and buying season we've ever seen, and likely at some discounted pricing.
I love that. Yeah. And I think that's been our approach as well, to really look at assets and really what are your goals? In my book, Fire Yourself, which Ken did the forward to behind me here, it's just when you compare cash flow and appreciation, cash flow, it's superior for a lot of people because it actually, you can pay bills with it, and it's much more stable in an asset when you have cash flow typically. Let's go around on that question as well. I guess when you're looking at multifamily or real estate versus other kind of things outside of that, I'm always interested to see, we obviously have our core businesses. Most of us on this panel are in real estate, and there's other things that we're doing. But let's start with Ken. What are some other things that you're finding interesting kind of outside of your regular genre there?
Yeah, so I kind of agree with Mikey. So we just fired up our construction company again, and we've had it before and we've outsourced it, and so we're actually bringing it in-house in Q1. And so we've got 2 projects under construction. One, we just put a business plan out, and we have 4 more in pre-development. And if you look at what interest rates did, is that they stopped new construction, because the cost, the mortgage payment went up a lot. It eliminates cash flow, and it's really difficult to build at 8 or 9% construction debt. So, not to mention the fact that they pulled back on their loans to value or their costs, I should say, their loan to cost. So anyway, so we see that as a massive opportunity. And so what we're doing is we have 7 projects. We actually have 1 stabilized. We have another one that's 50% occupied, and then we're breaking ground on another one in December. And then what we're planning on doing, because there's such a nice lag with apartments, these are not going to even be open in 25. They'll be open in 26, 27. And if you look at right now, apartments are kind of being disrupted with all the stuff that got started in 21, 22, let's say, whether, in various forms. And so that's all hitting. And so it's creating softness. So it's really good for the renter, good for the tenant. And also we're getting clobbered on expenses, like beating off the property tax and the insurance and labor costs and all those things. So things are all going the wrong way for apartments, but that's good if you're a buyer. And so when cap rates are up and interest rates are up and costs are up and occupancy's down, that's when you want to buy. So we feel like it's like a race almost. You got to get as much as you can in the next 18 months, and then you'll look like really, really smart, in say 26, 27, because there's just not a lot of new construction that will be opening, and most of that stuff will be absorbed. And so, you know, you got to take your lumps here in the next couple of years, buy right. We have 3 projects, very different. So I just bought a building in Las Vegas, Henderson, 347 units, 92 million. And we just closed on it maybe 2 months ago, and bought it at about 50,000 below replacement cost. So that's number 1. Number 2, we have another deal in escrow that hasn't been touched in 25 years, and the owner has no debt on it. And so that's a value add. But to Mikey's point, you know, we might just do a light one, because right now affordability is a problem. And so, you know, we'll probably do some things. And then we're going to build another 312 units, you know, that'll open up in 26. So 3 very different strategies. But to everyone's point here, there's a lot of product. I think Justin said it. You can always do something in this market, always, you know. And so this is the time to really. You do not want to be buying, and you do not want to be raising money when everybody to your left and right is doing it. You want to do it when it's a little more difficult, when people are in trouble, and you want to solve their problems for them. So I think I've been waiting for this time because everything's been bid up. So it's a great time to be an investor.
It is interesting, Ken. You know, it's the easiest time to raise millions of dollars is probably the worst time to invest or to be raising that capital. And I shared it Limitless at your awesome event that I think most of us here have been to. You know, that we've had a couple of we really struggled with, right? And so some real learnings there as well. And some of it's the debt and the other things. But right now, obviously, being greedy when others are fearful. And I think there's just great opportunity right now. So I love there's like 3 different projects, but definitely a bullish endorsement on real estate. Ellie, let's hear from you as well. I mean, obviously, multifamily, anything maybe you're doing personally as well, what you're seeing right now.
Yeah, and you know, it's interesting. We talked about a little bit before we started the conference today. What we see is actually a bit of a shift from sellers. So a lot of them were holding on to the 3% rate cap. They could have sold the assets for, you know, 2-3 years ago. Those days are gone. It took them time to make peace with the fact that that they will not be able to sell it at that much. And there has been some time where essentially brokers did not bring any deals because there was such a huge gap between the value in the market that the brokers knew about and analyzed, and how much the owners were really willing to sell the asset for, and the brokers did not want to work for free. And so there were not a lot of deals in the past 2 years, 18 months. And now where essentially sellers have come to term with where the market is right now, we see a lot more deals, and we see cap rates. They were 5 to 5.5%. Now we see deals trading at low 4s to low 5s, depending on the type of assets, of course. You know, we like to buy value add and core plus class B assets that are, you know, deals that are a little bit cleaner, no bad debt or very minimal bad debt, very, you know, light, maybe moderate value add. And so that's essentially what we see in the market from a deal flow standpoint. And I agree with Ken and with what you said earlier. It's investment is counterintuitive, because when everyone is afraid, when things go south, this is the best time to buy, because the deal that you're buying now at a 5.5 cap will be sold at a, you know, 4 3/4, 3, 4, 5 years from now. Because right now you're buying when the market is in a certain position, and that risk is priced already into whatever you're looking at for some of the deals, not for all of them. So when everyone is excited about investing, a lot of deals are bid up. You're actually buying at a higher, many times, not always, but you're more likely to buy at a higher price. And that will put more pressure on the back end when you're exiting in 3 to 5 years. So it's actually a very interesting time. And I do see a lot of sponsors that were buying with us, or, you know, alongside us years ago, that they're not really doing much right now, which is interesting, because the industry was very fragmented. There were a lot of options. I remember speaking with investors that said, well, I'm looking at three different, other investment opportunities. And we're talking about, most of our investors are doctors, lawyers, tech executives, business owners, small and, real estate investors. And they were sitting sometimes with 4 or 5 different offers, and now they have 1 or 2 because not many are buying. But I actually agree with Ken. This is great time, to buy right now. If you know what to look for. Not every deal is a great deal, but there are more good deals now than they were 2 and 3 years ago, and definitely 4 years ago.
Yeah, for sure. And it's just like the psychology of being an investor, right? Just really evaluating if things crash, it's time to load up potentially rather than run for the exits. But most of the time people don't. And I think this is why just even having these conversations around it is important. Mikey, why don't you talk to us a bit? I know I actually would love to hear also the distinction between right now, multifamily and self-storage, and kind of which one you like more right now. And of course you're in, I believe you're mostly in California. So seeing kind of what you're liking there, as well as any other assets that you're excited about personally, maybe outside of your core business.
Okay, so on the storage side, we're still doing deals, but there's less opportunity on storage, at least for what we do. There are so many states going through a housing crisis that, in my perspective, residential and more specifically multifamily, I think this is the real estate opportunity of our lifetime. So I'm very focused in on multifamily. We're doing 5 multifamily projects to every 1 storage. So that's where I see the opportunity. To be more specific, Ken knows this, you know this, Bronson. For everyone else, kind of brace yourself. I only invest in multifamily in California. And most people will not go near this state. And as we're talking about being the contrarian investor and doing what doesn't feel good, that's what I see the opportunity. For years, our state has made it so difficult to build with high regulation and, laws that are very pro-tenant, that it has driven investors out, and why so many people have seen this investor boom in the Midwest and these Sunbelt states. California has not been the center focus, but what that created is the largest housing crisis that our state has ever seen. And when Ken just said that, construction has completely halted, now me being on city council, the state has changed about 400 housing laws in our state that has forced cities to add new units. So now we're going through getting our housing numbers approved by the state. We're putting it into our general plan, and people aren't building, right? Now, I know why they're not building, but the market has put builders in a position where it's a standstill. Now, me as an investor, I want to be building at this time because 1, cap rates for us on multifamily in California have moved almost twice as much as they did in 2009. So we've seen the correction happen. 2, I want my brand new product coming online in 26 and 27 when everyone else is just starting to get this thing kind of churning again. So I think multifamily is the investment for everyone to focus on. I am very, very bullish on California. I love that most people are not here and that the state is kind of keeping competition out for us. I see that as the greatest opportunity. As far as other asset classes, I don't waste my time with them. Not because I don't like them, it's just something I learned a long time ago. Master the thing that you want to go all in at, and then put your money with others that are kind of specialized in that. I feel like I have the market covered as far as the assets I want to invest in. As far as outside stuff, I think fintech. I still like fintech. I like prop tech. I like some of these kind of software companies that you can plug into what we do on the real estate side. But for me, it's multifamily right now.
Yeah, that's awesome. And I imagine being on the city council, can you approve your own or kind of pull some strings to get some stuff?
That would defeat every reason why I did this, and I would then become the person I never wanted to. So for me, I do not invest in my area. And the challenge I have is I own a lot of apartments and storage units about 15 miles north. And so we have architects that I'll use for my firm that then will come in front of our city council. And when that happens, I typically have to remove myself from the vote.
Yeah, no, that's good. No, I just had to laugh because I thought, it's another below the radar way, but
Ken and I could talk all day about the political warfare that we're all dealing with.
Yeah. Yeah, it's crazy. Justin, I know you shared obviously cash flowing investments such as mobile home parks. I know you're also doing quite a bit in the business world, some VC, some other stuff. I'd love to hear kind of anything you want to share about real estate, as well as some of the other things that you're working on that you're excited about. Because I think you have a unique approach that you're like me. It's like, hey, what makes the most sense in any asset class right now?
Sure. Yeah. I mean, I could share a ton of asset classes and niches that I like. I'll probably be opposite of Mikey on this one. I think that there's two ways to do it. You can concentrate and go in one area, and depending on, you know, if that is your business, you probably should do that, right? So I would say Mikey should be doing that all day long. I love that he's doing that, because as an investor, that's what I would want from the people running the business. For me and my portfolio, I really like to model it off of what other very wealthy families are doing, because they probably have access to information that I don't. And so I'm always looking at what the trends are, what percentage allocation are they in different things. And so I've got this down to, you know, a science, and I read all this data, which is probably boring to most people, but you know, just real quick, I'll rattle a handful off. Onshoring, with more onshoring, reshoring, it is creating, you know, more products being produced here. It's creating more trade with Mexico, and it's minimizing trade with China, but it's going to increase trade with a lot of other countries. And so I like the idea of real estate around border towns and around port cities. I'm very bullish on those. And by the way, including multifamily. So we've got a lot of multifamily people here. I'm a big fan of that. I'm a big fan on the industrial side as well. One of my favorite investments that I've done recently, Mikey, you'll appreciate this because it's actually in California, near the port in Long Beach, one of the biggest ports in the US. And it's industrial outdoor storage, a niche class of industrial storage that has been a killer deal for us, that we got way under market from an 86-year-old guy that tried to sell it before, and the deal didn't go through, and basically he needed to turn this thing quickly, and we came in to do it at a major discount. So that's been a really cool one. We're doing a retail conversion to self-storage, which has been very successful. So instead of a ground up, you know, you already had the existing building and you just convert it over. And that's been, you know, we've just done a little bit at a time, and kept the retail paying retail while we did, you know, the ones whenever we'd lose a tenant, we'd flip those and convert those. So that's been good. Private credit. I'm a huge fan of private credit right now in this market, in the season, if it's done right, if it's low leverage or no leverage. That to me is a slam dunk, and I'm in a ton of those deals that are paying anywhere from 9 to 20%, depending on, all highly collateralized, low leverage, just across the board, depending on what industry it's in. So that one's fun. You know, buying small and medium-sized businesses, I still am doing that all day, every day, but only if there's an operator that I can either A, plug in, or B, already exists. And again, these need to cash flow. Like everything I'm talking about here needs to cash flow. There is, you know, here's something. Pro sports are just becoming more and more valuable. So I've been investing in minority equity positions in pro sports teams through the groups and the funds and the SPVs that allow us to do that. And for those that, you know, that you really have to know the right people, and it's you're getting really small minority positions, but these companies are I mean, these brands are huge. You know, you control the media rights, and you are just going to continue to create value through and through every single year. And I think an under promoted or like I guess a category that isn't really discussed is esports. I invested in my first esports team, and I think that is going to take off because of how big it is internationally and the eyeballs that controls. GP stakes, getting in on the GP side of things in a bunch of different funds. You know, there are many funds that do this, that go into all these different deals or all these different assets. So that one's been pretty good. Companies with long-term government contracts. There's a few different, I guess, niche categories here, whether it be early stage, mid stage, or late stage. But some of these are selling at a discount. And then, of course, you've got robotics and AI, which those are catchy now, but I've been investing in those for a decade, and I still like them today. I mean, I could go on and on and on, but that's just like 10 to 12 off the top of my head.
I recommend your book too. You got your book behind you, Lifestyle Investor. Everybody check that out. Thanks for sharing that. Yeah, and I think I'll just add a couple thoughts too. Obviously, I love multifamily now for all the reasons that were shared. I think it's an incredibly in-demand asset that the shortage of supply is only going to continue, or we're going to have shortages there, and we're growing population, and so I think it's something that we're seeing discounts 20 to 40% in great markets. It's like, why not load up? So, and then we have also been getting involved. This hasn't been mentioned, oil and gas. We've been starting to do more oil and gas stuff because of commodity pricing. We really like that for the tax benefits, as well as the cash flow, just having great cash flow and tax benefits. It's kind of a double positive. So we just did a deal recently with that. And then we have a business. This is for our company. We are purchasing a e-commerce business, and it's very high cash flow. And I have a partner who's really great, and we're excited about it. Right, buying a business that cash flows well and doing it with a little bit of debt and making it work. So trying to find new things are great. So I love having those conversations on different assets and things that are solid. So wanted to ask you guys one more question, then we're going to open it up for questions. And again, I know we could probably talk for an entire day and have plenty to talk about, but I wanted to ask particularly around some investors have been pinched by deals that maybe haven't gone well. And of course, there's this thing called hindsight bias, that looking back, oh, it's obvious why it didn't work out, or why something happened, or why a deal didn't work. But what are some assumptions, I guess, or when it comes to underwriting, when it looks at underwriting real estate deals, development deals, even business deals, what are some assumptions or just the metrics we should use now for doing underwriters, some things maybe people don't consider? Let's start with Ken. We'll kind of work our way around.
Well, thank you for asking. I don't think they've changed. I think that people, like I think what happens a lot of times, like I think of my own family, like they put their money with a wealth manager, and then they don't know really what it's invested in, and they kind of hope, and they open their quarterly statement. That's exactly what a lot of people did. They believe the hype, they believe the marketing materials, they believe next year is going to be better than last year. So if you're going to put your hard-earned money or raise money for somebody, you better make sure that you understand, all the stuff that Mikey was talking about earlier. You have to do all those stress tests. What if it's 80% occupied? What if it's a month free? What if these expenses go up? And you have to look at it from all angles. And I think what happened is, there were a lot of people that were teaching people how to raise money in this last cycle. And they didn't do anything wrong, except just because somebody's gone through a real estate school or whatever it is, doesn't mean that they know how to do it. And so, so they got the courage to go out and do it. And so what oftentimes can really cover up problems, and that's what happened in the last 10 years, don't forget, was the market cycle. The reason the market cycle went up was not because people were good investors, period. Like what happened is that we were in a massive shortage of housing. That actually was from the decade before. And, because I went through the 08 problem. So 08, people were cranking through 07, 6, 08, everything stopped. And then 9, 10, 11, 12, 13, 14, nothing really significant, right? So you have this very, very big lag of no housing. And then, everybody got this run up after that. And they were like, oh, this is easy. I just need to go raise a bunch of money and buy something. And it was worth more. But all the fundamentals like property management and underwriting and, lending and all the things that are supposed to have a little bit of attention to them. And they're supposed to be, this business is it's hard. And it requires wisdom. It requires experience. It requires more than just raising money and buying something. And so that's actually what happened. It's exactly the same as if somebody turns over their money to a financial planner and then goes on vacation. So they didn't know what to ask. And so I don't feel like the fundamentals have changed at all. One of the key things that Justin said was everything he does has to cash flow. Okay, if you just do that, which almost no one did, like, because cash flow saves everything. Like
Yeah.
your assumptions can be wrong, you know, and if you underwrite it correctly, like Mikey was saying, you're gonna be fine. I bought stuff in 05, 6, 7 in Austin, Texas that was not worth what I paid, you know, because the market went down after that. And what saved my butt was the cash flow. And you know, and so there's all these things that you learn as you kind of move forward. So I think the LPs are finally realizing that, one, things don't always go up, but two, who you decide to put your money with. Like you hear what like the list that Justin just ran through, and you know there's so much more. Like that's a guy that you want to sit down with and talk to, right? Because he's actually doing it. Same thing with Mikey. We're actually doing it. And so, you know, I'm doing a recapitalization on properties that I've owned 15 years right now. And I'm going back and scooping equity out of stuff. You know, I've been doing this for 30 years. And so I've seen ups and downs. And when I was younger, I was a little blind. Yeah, everything, you know, everything's blue sky. Well, it's not, you know, and so that's all that's happening. And you know, I think the LPs are starting to see who are the good operators, you know, and who are the ones that are getting the lessons. And that's actually what you're seeing. It'll work itself out. People will lose some money for sure. But it doesn't necessarily mean that it's a bad asset class.
Yeah, absolutely. Well, and I think too, one thing I've realized is when something doesn't go well, which you invest long enough, something will happen, right? Nothing ever goes as planned, but I think it's the lessons that you learn, right? I've had lessons that, you know, I used to options trade and I lost $70,000 in one day. I talk about my book, and I learned I'm not a great options trader, right? So I should do other things that better hit my skill set. So I really appreciate that, Ken. Ellie, what about you? Let's talk a little bit about underwriting and kind of what you're seeing and how just lessons people should take from, you know, this season, or what they should apply right now.
Yeah, absolutely. I think there are three main things to consider when any investor is considering investing in every deal. Forget about how nice the offer memorandum is. Marketing can do a phenomenal job. Just ignore the nice pictures, the graphics. They can be very confusing. There are three things that I would focus on and ask the sponsor. The first one would be, how much do you invest in the deal? Because if you're not putting your own money, then it's probably not so great for you guys as well. But one thing I would ask, and this is something that we've developed in-house, and we're making sure that we do that on every deal. We're actually getting all the pipeline. So there are three things. One is the pipeline of the competition. You have to ask every sponsor, have you looked at it? What does it look like? So if the sponsor doesn't know, in every quarter for the next 5 years, 4 years, as long as you're holding the asset, how many units are going to become available, then they haven't really taken the competition into consideration, because you will need to provide some concessions and do something, maybe lower rents temporarily until all the new doors are going to be absorbed. And again, I've learned that from past mistakes where I said, it's going to be great. We have a better asset and we have $500-600 delta between us and the next really, you know, nice building that someone was building. And then that delta was gone in one day, and we were competing for the same rents. And of course our occupancy suffered. Since then we've exited and we were doing fine, but that was a very painful lesson. And so first question, what is what are the competition doing in terms of, deliveries? Did you take that into account? What's your plan? Are you lowering rents during that time? Because your rents are not going to stay the same if there's a new building across the street. The second thing to ask is, what are your thoughts behind rent growth? It's very easy, and you'll be amazed when you're looking at an underwriting model. 5% rent growth year over year versus 1%, that can make or break the deal. 15% IRR can turn into 7. So I'm not saying the 5 is always wrong. It used to be very easy to get it. We get it on some assets. We have even 10% on some assets. You know, it's very hard to get to that number. It can be 2 or 3%. So always ask, that's the second question, ask every sponsor, what are your thoughts? Where did you get the data? Why do you think you can increase rents by X amount? And it's very, very important for you investors to understand that and be okay with it and feel comfortable with that, with that assumption. And then the third one, and it's a big one, of course, is the debt. Are you taking fixed rate loan? Are you taking bridge? Is it, you know, do you have a rate cap in place? You know, bridge is something we're trying to stay away from, but it doesn't mean that we're not going to do it in the future if it's going to make sense, but there's got to be a plan. You have to buy rate cap so your interest rate is not 8-9%. So I would focus on those 3 items: the debt, the rent growth assumptions, and the pipeline. They're all very, very crucial when it comes to underwriting, and it's very hard to predict, you know, every line item in your pro forma 5 years down the road, but these are the big 3 things you can be conservative about, and that would account for most of the cash flow and the sale proceeds on the back end.
It's a great feedback. Thanks, Ellie. Really appreciate that. It's wonderful. Mikey, what would you add to the conversation here as far as diligence and just assumptions, and when an investor looks at a deal, what should they be looking for?
Yeah, this is why they say, what is it? At the end of a deal, the LP has all the knowledge and the GP has all the money. It's unfortunately, you hear these horror stories a lot, right? I think, you know, Ellie's recommendation was great. The only thing I would add to that is looking at your forward-looking cap rates. This is a big one. When you're talking about return, you're typically not going to get to that projected return through cash flow alone. There's typically an appreciation component to it. So you want to ask where they got their cap rate from. Most of them are going to tell you CoStar, and ask them to present not only CoStar's forward-looking cap rate, but ask them for what cap rates looked like over the last 10 plus years historically, and see if they're actually accurate with it. And then the next step is look at what your return looks like if cap rates move by a percentage point. That could wash away your entire return. The other thing I would add, and this is kind of the hard part, because most LPs don't know the questions to ask, and they don't really know what market rate is for the pro forma that they're looking at. So maybe you could actually look at it from like an emotional lens. If somebody is giving you all the tactics that feel like you are missing out, maybe that's something that you should put the brakes on. If it's a drive towards emotion to act. You know, I think you should always ask the operator to tell you about something that went wrong. And if an operator tells you that nothing's ever gone wrong, they're either lying or they haven't been doing this long enough. And here's the important part. It's okay that they're telling you about something that went wrong. What you're trying to gather in the operator is, when they were faced with a challenge, what did they do? How did they think about finding a solution to it? And then what was the outcome because of it? The experienced operators that are going to be here over the next 20 years will very clearly tell you, yeah, this was our assumption. This is where we messed up. This is how we solved that problem. And this was the impact to return. But whenever you get an operator that's trying to hide mistakes and tell you that, you know, everything they do turns to gold, that's typically one that you should run from.
It's a good word, man. I love how succinct that was. Thank you. That's really good. Justin, I know you just said you completed a course on this topic. So give us your nuggets here.
Yeah, so I'm going to try to not repeat anything anyone said unless it's super important. But I just felt like the average investor is so underserved in this category. They don't know what they don't know. They don't even know what they need to know. And so I just felt like education needs to be done here. And you know, I'm going to rattle off a few things. I think first and foremost, there's a difference between an optimist and an investor. And if you are an optimist, or if you enter into the category as an optimist, you're probably not going to do really well. Most people start from the standpoint of like, oh, this is a good deal. My friend did it, or someone that I know is smarter than me did it. That's a horrible reason to invest. Like you have to do your own due diligence, no matter who invested. And I started doing a lot better when I entered deals saying, you know what, this deal's probably horrible unless I can prove it wrong, versus this is a great deal, unless I can prove it wrong. Does that make sense? So like starting with a no and working your way to a yes is so important. I want to see pro formas that have 3 different, I want a best case, a base case, a worst case. Like I want to know what they think. I want them to bank their numbers on something conservative. And at the end of the day, I'm not even that concerned about the current pro forma. I want to know that it's conservatively done, but I actually care more about their last pro forma and the one before that and the deals that they've had that have gone full cycle and what those look like. I think, I'll tell a short little story, but I've had friends over the past, there was a decade of like crazy returns, crazy results in multifamily where you could do nothing wrong. And my friends thought I was crazy when I wouldn't do these deals that they would flip really quick and have a huge return. But I didn't do anything that didn't have long-term fixed debt, like good interest rate, long-term fixed debt. I didn't do any of the bridge loans or floating rates or anything like that. And I had a lot of friends make a lot of money and they kind of laughed at me like, you're missing out on all these great deals. But once interest rates went up, I've got somewhere between 300 and 400 active investments right now as we speak. Not all of them are real estate, but let's just say 25% of them are real estate. Let's just call it 100 deals. I had 0 deals that I was in that were impacted by the interest rate environment. All of them had long-term debt on them. And so my friends who were laughing before that I was missing out on these great deals, they lost a lot of money on the deals that were still mid-cycle. And so, having that long-term debt is important. I think you have to invest in the jockey. Like that's the person who's going to get the deal done. That's who I care the most about. And I want people to have reps. Like I want to know that they've been through many deals in the past. Like, this group here is a very established group. I want to know that they've done deals, that they've gotten good results, that they've actually been at or above the pro forma, so they know what they're doing. That to me is important. And then fees. I mean, right now I am seeing so many groups with the most horrendous fees I have ever seen. Fees for anything and everything, not only fees that are above market in the typical categories, but like extra fees that most groups don't have. And I think your retail investor is going to be duped pretty quickly. And then I think it's also important for those, I saw some stuff here in the chat about, tax strategies and tax savings. I think it's important that you don't ever do a deal for the tax strategy. You do a deal because it's a good deal. And then if you get tax advantages because of that deal, great. But you can't just invest in an opportunity zone or a high depreciation deal because you need the write-off. Like that's a recipe for absolute disaster 9 out of 10 times, probably even more than that. Maybe it's 9.8 out of 10 times. And then, the word value add. Oh my goodness, value add. Can I just tell you that's the catchphrase of the century, and everyone's deal is a value add deal, whether it's really value add or not. So you got to dig in and say, well, what do you mean by value add? And see if there's really the value to be put in it based on other market comps in the area and what they're actually going to do. Like, is there a market for what they're talking about? And then just last but not least, the sponsor has to have skin in the game. They have to have a decent amount of their net worth or a decent amount of the overall capital raised in. They've got to be pot committed. They got to have skin.
Wow. Well, I feel like that was so much value just dropped by everybody in this. If you guys give them some love in the chat, there's just some stuff you got out of that. That was awesome. But I mean, from every single person shared some nuggets. The only thing I know, Mikey has to leave, so we'll give Mikey some love there. He's got his Instagram handle. He's got a ton of, actually, I think you put it to hosts and panelists. So I'm going to just copy that and put it to everybody. But yeah, appreciate you being here, Mikey. And you got to run and go save the city and do all the great things that you're doing. So appreciate you, brother. And hopefully we'll have you back on here again. Just so grateful for you, man.
Thanks for having me. Great seeing everybody.
Okay. Thanks, brother. Okay. We're going to take some questions here in a minute. If you want to drop some questions in the chat, we have time for maybe 1 or 2 questions. The only thing I will add to what was shared, maybe hasn't been shared, I talk about this a bit in my book, is just as a newer investor or somebody who's an investor, there's always a story. And what are the ways, first, you're going to make money, but even more importantly, what's the primary risk or the 1 or 2 risks of ways you could lose money? And I always ask that to potential operators. I wouldn't tell them what I think. I said, well, what do you think is the biggest risk of this deal? And it's a great learning experience just to see if you're understanding it correctly. And if you don't understand there's a risk or what the risks are, then you don't understand it well enough, because there's always a risk. So I think that's all really good. So let's go. We're getting some questions in here. here. Again, go ahead and keep dropping these in the chat here. There's a question: what approach do you recommend to investors to become better educated investors? So I guess this question is more about education. What are, I guess, books, courses, resources, things that you'd suggest? Hey, how do I get more educated? Anybody can just jump in.
I'd say get around people that are really great at it. So whether it's joining masterminds, hiring a coach, taking a course, I would just dive into it, both feet. I remember at one point in my life, I felt like I could outsource things because that was the better way. There are all these experts, but I realized with my finances, with my investments, like these are things that I need to in-house, not outsource. Like I actually need to have skills and chops to be able to identify and recognize if things are going well or not. But I think there's no better money spent than on peer group, on education, and on mentors.
Yeah.
Love it.
I
Great
agree
word.
with that. I have 2 young men coming to my office Friday that are in my mastermind specifically because they've been trying to buy multifamily, sending me deals. I've been talking to them, and finally I just said, just come to my office and let's really scrub this down. Justin's right. Like if you're going to invest your money or other people's, you have to be shot down a lot. Like everything should be a no until it's a yes.
Yeah.
Every deal I ever buy, I'm like, what did I miss? Like I'm always like, that's what's going on in my head. Like, what am I, even after all these years, what am I missing? And so it's smart when, people get together in these peer groups. I'm not talking about lifestyle coaching. I'm talking about finding an expert. They joined my mastermind specifically so that they could run deals by me. And they're utilizing it as, that's the whole point. So that's how you shortcut things that way. And I'll tell you what, you learn a lot.
Absolutely. No, that's great. Ellie, what would you add?
I would say as a passive investor, I would listen to podcasts a lot because there's a lot of golden nuggets, things that, people on the podcast would share that they're not necessarily going to share on the, when they write a book, which, books are great and you can definitely, learn this way, but just listen to the podcast, I think would open up your mind even to, we're buying, assets all over the US, but I always enjoy listening to someone else on a podcast explaining what they do if they do things a bit differently. For instance, when COVID hit, we did renovation on demand where we did not know at first if renovation is going to be very popular at a certain asset. So we let tenants choose whether they want to invest in a classic unit, non-renovated unit, meaning, or in a renovated unit. So we knew before they came in that this unit is already taken. So we streamlined our process in that way. So something like this, for instance, someone else can hear that, idea and implement it, and you can always learn from someone else. But also, I think you get a lot of good information here in how things are being done behind the scenes. And so I'm a huge believer of podcasts. You can listen to it when you're getting ready in the morning. There's always things to learn. It doesn't matter. We can be, I've been in real estate since 2007, 2006. And there's not even one year that I don't learn something new. There's always something else. You always think you prepare yourself because you've learned of this cycle, and then the next cycle is completely different. And there's always things that you can learn. So podcast for me, it's the number one source for, for knowledge, whether I'm a sponsor or a passive investor.
I would say too, there's more than probably in any time in history. There's just so much information out there on this. I mean, every person on this stage here has podcasts, YouTube channels, has all written books, done different things. There's so much there. Also, ChatGPT is great for just help me understand this idea or help me talk to me as an educator in this specific concept. It's awesome. I have a new book coming out. It's called Rich Brain: How the Wealthy Changed their brain to change their bank account. It comes from interviews I did with over 2,500 millionaires, and one of the things in there is just the never ending learning that people that are highly successful do. I mean, every single one of these people are reading and learning, and you know, I can get into stats on that, and it's super, super valuable. So I encourage each of you to do more and more reading. So I want to make sure we're sensitive to everyone's time. So appreciate our panelists and our attendees for being here as well. I know we have many more questions, would love to get to all of them. I'm sorry we weren't able to get to all of them. I thought the conversation was good. If you enjoyed the conversation, please give them some love in the chat or hit an emoji or something. I'd love to see that. But let's go around and just see if people want to follow you. How can they get in touch and follow what you're doing? Is there anything that you're working on you wanted to be able to share with the audience? Let's start with Ken.
Sure. Well, all my YouTube and podcasts and stuff is under kenmcelroy.com. So pretty easy there. And then our company is MC Companies, MCCOMPANIES.com. And that's a development company, construction company, property management company, asset management, all of that inside of there.
Awesome. Thanks, Ken. Appreciate you, brother. Justin.
Yeah, by the way, it's so great that you're so integrated, Ken. You've got you got the stack of everything, right? So it's a one-stop shop.
Yeah.
There's a lot of synergies in having your own construction company, doing your own development deal, doing right, and you're stacking. So super, super smart. You can find me at lifestyleinvestor.com. So, you know, from book to podcast to online courses, master classes. I've got a couple different masterminds. Ours are all pretty high ticket, and we've got a wait list on Lifestyle Investor, and our lower ticket is open now. We've been kind of expanding that community. So Lifestyle Investor, you can find everything there and all kinds of free content as well. I've got a blog. I've got all kinds of stuff, a tax strategy masterclass, vetting deals course, mobile home park investing course, you name it.
Awesome. Thanks so much, Justin. Ellie, how can people follow and get in touch with you?
Yeah, absolutely. So you can go to bluelake-capital.com. That's our website, Blue Lake Capital's website. And people can also email me at ellie@bluelake-capital.com. You asked earlier what we're working on. Usually there's at least one deal that we're working on. So we have one under contract right now. And we're excited for next year for sure. But you know, if Google my name, go to bluelake-capital.com. That's how you can get in touch with me.
Awesome. Thank you so much. Appreciate you guys being here. I just wanted to give for the calendar for the audience here as well. So November 12th, we have a event on buying businesses. If you're interested in buying a business, or passively investing in those that buy businesses, it's going to be we've got some just real rock stars we're looking for. I haven't finalized the attendee or the panelist list yet, but it's going to be awesome. And then we have a tax strategy event in December that's going to be great as well. So appreciate everybody being here. Thank you, Ellie, Justin, and Ken, as well as Mike, who had to leave early and go be with his city council. But yes, Justin.
I got one more thing. If anyone wants to figure out like what are your next steps, you know, we have these strategy sessions that we do with people, and generally we charge $500 for them. But if anyone wants this, we'll just do it for free for this community. So lifestyleinvestor.com/consultation.
Awesome. Awesome. That's a great giveaway. Thank you, guys. Awesome. Well, I appreciate it. This will be available on a replay. We will email it out to you, and I appreciate everybody being here. Thank you so much to our panelists. This was an awesome event, and I look forward to seeing each of you soon.
Thank you, Bronson.
Thanks,
Thank you,
guys. Thanks,
everyone.
everyone.
Good
Thanks a
seeing
lot.
you guys,
Thanks.
as
Yeah.
always.
Bye.
Cheers.